Welcome to IVoT Eye on Investing, where our experts look at the economy, the market, and particular companies from a long-term fundamental perspective. IVoT Financial Training Incorporated is a company committed to making financial mastery accessible to everyone. To learn more, go to IVoT.academy. My name is Emile Westergaard, and I am the founder of IVoT. I spent 20 years as a professional investor and believe that understanding how to analyze and value investments is a core life skill that needs to be learned to be effective in the modern global economy. This week on IVoT Eye on Investing, host Ed Butowksy and IVoT market analyst Andrew Tang discuss the potential impact of the Gaza peace agreement on the global economy. IVoT founder and equity analyst Emile Westergaard then previews Tesla's upcoming third quarter using the IVoT Forecaster, and they discuss what it will take for Tesla to increase its cash flow 5 times, which is what is implied by its current share price. If you are a member of IVoT Academy, get out your IVoT Tesla Forecaster and play along. Let's get started.
Hello, everybody. Welcome to IVoT Eye on Investing. Today we have, as always, our founder, Emile Westergaard, who's the founder of IVoT, and we have our think tank leader, Andrew Tang. Thank you both for joining us today.
Thanks.
So, Andrew, we were just talking, and I wanted to make sure we got this on camera, about the impact of the Gaza situation and what that's going to do to the world markets. I don't think anybody's really heard this perspective before, and I find it really fascinating.
Yeah, obviously we have a lot of different economic news and we can talk about that, but front and center, what's really happening that is very important in history is there's peace in the Middle East, and it rhymes, peace in the Middle East. And who was the last person that got that done? And it was President Bill Clinton. And that was done with Yasser Arafat at that time. Now, did it last? Well, it sure did, at least for a few years, right? And that's all we can hope for. What are our expectations? Now, our president flew over there personally to see to it that the signing agreement gets done, work with Egypt and Qatar and put a lot of pressure on Hamas. And that's why Hamas was agreed to sign. Now, there are still conflict, with this deal, more from the Hamas side. But either way, we have to appreciate peace when peace is achieved. And from an economic standpoint, okay, what do we do from here? What's the impact to the world? Well, if you take a look at the map of Gaza, it's literally flat. The area is not that big, it's not too small, but rebuilding it, it's going to spur economic activity, and that is good. It bodes well for economic activities for the local region. And from my estimate, it's going to spill over to roughly about 10 to 15% growth contributed to US and also to EU as well. And so what would that be? Well, that could be material, that could be equipment, that also could be service folks that are going over, consultants, architect, designers. So all that come into play. And I think combining with the economic expansions that really span from 2016 to where we are right now, I know everybody is talking about, is this AI bubble going to pop? But from the last previous episodes, we already talked about that we're really not done, with this transition from general purpose computing to accelerated computing. I'm not going to get into all that, but combining with the economic expansion from tech innovation, rebuilding of Gaza, and we're right in front of 2 to 3, at least interest rate cuts that are in front of us. Labor data, it's somewhat under control. if we pan this right, rebuilding Gaza should not spur inflation too much. Um, and then the rate cuts are going to follow through as expected. And again, neutral zone for interest rates in the US is somewhere between 2.5 to 3.5%. So it is still quite high. And that is the reason why the most recent mortgage application is still anemic, right? We're not building so much that we have a glut like 2008, and for sure, builders right now they are really adapting the just-in-time model, meaning they have to see demand before they can commit capital. It's very rare that builders will build a house and throw in the market and see what happens. That way of doing business is really no longer the fact. As a matter of fact, that style of doing business carried over to the auto industry as well, right? So when auto industry were in trouble, they have to choose scale or they have to choose price. So they all chose price. We rather sell less cars, but we want to maintain a high price. So going back to Gaza, going back to economic activity, I think this is a perfect storm for the major increase in human capital and human productivity. And that in turn, it's going to tick up our global GDP as well. And that's why we see IMF, you see the World Bank, they all increase the outlook for 2025. But they're not so sure about 2026, for next year. But I think overall, next year, we're going to see disinflation kicking even further and productivity kicking even higher. And that will be a surprise upside on the GDP side, at least from the US speaking. Yeah.
So there's a lot of smart cities that are being built all over the globe. In the United States, just north of Dallas, near Sherman, they're thinking about building a smart city, which is a very high-tech city with no cars. I wonder if Gaza, could end up being like that.
Yeah, well, we have to see, to answer that properly, we have to see the existing population and their demographics compared to what could be, right? If you stuff the different culture into a city that doesn't fit, who knows what that's going to be like. But I'll tell you this, that when they do rebuild, it's going to be modern. Just like how the existing, our current administration, it's really encouraging businesses from around the world to invest in the US. Why? We have the best chips, we have the infrastructure, and we have the best financial markets to raise capital. Okay. So the distribution and also the capital markets are good. The tech stack is also excellent, and that is ripe for investing. And that's why many companies around the world, they're all committing to invest in the US, right? Remember, there's $5 trillion that's supposed to happen. Again, this is the effort to remake the industrial revolution or the manufacturing aspects of the industrial revolution back into the US. Now, when they rebuild factories, it's going to be modern factories. Modern factories going to be armed with automation, both from software and hardware perspective. And so, yeah, it's going to be something pretty fantastic.
So let's talk about something other than Gaza. Let's talk about the FOMC meeting and what the minutes revealed last week.
Yeah, the minutes really reveal something wonderful because for once we have an agreement, so to speak, that we're going to see more rate cuts confirmed by the Federal Reserve. And this is very important because what Jay Powell said is that we are going to be expecting a few more rate cuts, in plain English. That's what it means. And we see that the different Fed presidents at various states, they all concur. And even one president said that we should lower rates even further, like 50 basis point cuts. But either way, I think the general masses or the investors, Always complain about the Fed, saying that the Fed is too late to raise and the Fed is too late to cut, and so on and so forth. But I do understand the dual mandate. I do understand the difficulty that you can't rush things. But however, I'm just grateful that we are in the path of three more rate cuts down the road. And
So do
again,
you think the rate cuts are concerning or aspirational? Meaning, are they
oh,
concerning because of the GDP numbers being low, or are they aspirational because inflation is coming in lower?
Ed, let me put it to you this way. I cannot emphasize enough how badly needed the interest rate cuts, for the U.S. For one, we have a really high level of debt, 37.6 trillion of debt, equals to over $1 trillion of interest payments, okay, at the rate that we are right now per year, okay? And just to look back, that's over 20% of the entire nation's fiscal budget, just 2 years ago. And that is not sustainable. On top of all that, and again, mostly private, I know we talk about stocks a lot, but if you look at general business altogether, the majority of business is still private. Okay. Now, in terms of private business, there's over $2 trillion of loans that come and due and that needs to roll over. Many businesses, especially on the real estate development side, commercial leasing, any business that really have a loan exit out there, they can't afford to reborrow at these higher rates. So many businesses are basically, in ICU right now. Many folded, uh, many also had gone through foreclosures and then, the vultures, the hedge funds and the private funds, they come and snap up cheaper assets. That has happened. You see commercial real estate, you didn't really hear about them blowing up, but silently in the background, there are a lot of anemic and companies that are basically flatlining and going out of business. And so I can't emphasize enough how badly we need this interest rate cut, and not to mention retail or household, aspects of real estate, you know. So
Let me ask you a question, because I mean, those numbers sound obviously big, right? So you've got 36 trillion of debt, $1 trillion in payments per year. 37, right,
37.6.
right. Yeah.
Yeah.
But in my mind, if I think of the United States as a company and the GDP is 30 trillion. If I think about that as the revenues of the company, and on a $30 trillion revenue base, they've got a $1 trillion debt payment. That, as percentages seems to me, not out of line. I mean, again, the numbers have become so big that you say a trillion and it sounds scary, but, I think, I just wonder if it's more of a headline thing than the actual a problem. I mean, 1 trillion on 30 trillion of revenues doesn't seem to me to be an exorbitant amount of debt payment.
That's assuming that the 30 trillion is all paying taxes.
Yeah,
The tax base on that.
exactly. So the revenue, doing business is one thing. The revenue for the United States, for our government, it's not 30 trillion, right? Those are the taxes that are receivable. So currently there is a very important ratio that we can look at. It's called the US debt to GDP ratio. And right now it's approximately at 124%. And that is extremely high, extremely high. And so,
Okay, so that's a better number, because it says here that the U.S. annual tax revenues are 5 trillion.
yeah.
So then you're talking about 20% annual debt payment on 5 trillion of tax revenue. Is that, which again, that's hot. That seems, 20% of your revenues going towards debt is definitely high. Okay,
Yeah.
we'll go with that.
So 5 trillion was the entire fiscal budget of the nation 2 years ago. 5
Right.
trillion. Right. And now the taxable receipts is 5 trillion unless this taxable receipts grow at an astonishing rate. Yes, we can grow out of this. And alongside with inflation, it will also, make the debt burden, reduce as well. But it is just not realistic to make those assumptions.
Well, yeah, so in the context of this, and I want to move on to our stock of the week, but our stock of the week is really a preview. We don't have to spend that much time on it. We've talked about it a bunch, Tesla. But just before we go there, I live in Peru, and the dollar just hit a 5-year low against the sol. So for us Peruvians making money in dollars and living cheap down here, there's been kind of a little that's not working as well as it did. I mean, I think I can remember it was close to 4 soles per dollar not that long ago. It's now all the way down to 3.4, which is a pretty significant downward move. I wonder, again, how much do we have to worry about the stability of the dollar given these things, given these kind of basic fiscal issues we're talking about? How much does that play into the issue of rate cuts? Because obviously that becomes eventually something that causes the dollar to lose value.
Well, I'll put it to you this way. The value of the dollar, also why gold is rising, is because the US and the G20 countries, we have too much debt. When we have too much debt and the risk level of the ability of that country to resolve their fiscal problems, that will increase the likelihood for central banks around the world to buy gold to shore up, the value of their currency, to strengthen their basically their currency. And that's why gold is at these astronomical levels. I call it the "in God we don't trust," the flight to safety metals. And, because every currency in the US dollar, in God we trust, right? So in God we don't trust, when you don't trust the central banks and you don't trust the fiat currency, you go to gold. And then now we have, of course, Bitcoin as well, that some people call it the digital gold. Okay. And that is really a function or reflection of investors not trusting the ability of our government or any other G20 governments to solve their fiscal problem properly or fast or quickly.
But Emile, I think it's really important to point out that we bring in about $5 trillion of tax revenue. That's the only way that the United States brings in money other than selling some buildings, which are one-offs. But it's important to note that the $1 trillion of interest payments is 20% of what we bring in. And it's a negative spiral that's only going to get worse unless we somehow figure it out. And the only way we're going to figure it out is if we have a war, because that's how we've always figured out our debt problems.
That's what China calls U.S. China calls U.S. warmonger,
So Emile, why don't we go ahead and take a look at Tesla? For those of you who are new to IVoT Ion Investing, Emile is the founder of IVoT and the forecasting tool that he's going to highlight. And anybody who is interested can go to IVoT Academy and sign up for this.
Yeah, so let's just quickly. So this is not quickly. This is the third quarter preview, right? So Tesla will be reporting its third quarter on the 22nd, so next week on Wednesday. And we wanted to take a look headed into the quarter. It's one of our kind of bellwether stocks and one that I know Andrew has a lot to say about. But I just wanted to kind of use the forecaster to look at the numbers. So anyway, Tesla's up about 11% this year, but has had a rough October, down 7% in October. From a pure IVoT perspective, and let's just open up the tool here. Again, the forecaster is a cash flow valuation methodology. And I'm going to share a screen and go to the tool here and just walk through kind of what this tool is saying. So here's the tool for Tesla, and I can go in a little closer. So you can see, and this is a $1.6 trillion market cap. The cash flow in the last quarter, the fiscal second quarter, was 2.1 billion, which is down from 3 trillion a year ago. So from a fundamental perspective, that was a pretty lousy quarter, down 900 million in cash flow, down 30% year over year. The cash flow value of the current, or the implied value according to our tool of the current cash flow stream, is $70 a share. And you're paying 404, well, I think it's down a little bit on this from this quote, 420, 425 right now for the stock. You can see the cash flow value was higher a year ago because cash flow was higher. It was $95 a year ago. Now, the way we teach this at IVoT is the current stock price is what the market thinks Tesla will be worth in 3 years. Because the market's a forward-looking vehicle. Market can't look further than 3 years. That's too abstract. So we want to say that the market's telling us that in 3 years, this $70 cash flow stream will grow to be worth $440, which is 80% compound growth. So in essence, the way we read the tea leaves is that the market is telling us that they're expecting cash flow to grow by 80% compounded over the next 3 years, and that's what the $444 price represents. That's obviously a massive turnaround from the most recent 30% decline, roughly. So what's going to cause this massive turnaround in the business? You know, there's the electric car sales have been struggling. A lot more competition around the world, a lot more cars coming too. So there's more competition, I think, coming in the electric car market over the next couple of years. So I guess, is there a big turnaround in that base auto sales? Or is it, you know, I think what we've talked about in the past, and what I think we can get an update, hopefully, in kind of what we expect to hear in the quarter from Andrew, maybe. But, you know, the other side of the coin here is the AI-based autonomous driving vehicles, the robo-taxis, and maybe also some more significant growth in the battery business, in their battery packs. So let me just say one more thing before we go. So let's just take this for a minute. In order to get to this $70 up to $444, obviously, two things have to happen. Sales have to grow, and let's just say they can grow sales at 50%. That would, in 3 years, according to our tool, take you up to $119. Not enough to get you close to where they're trading. Now, the other side of this coin would be, what if the costs come down? Now, 2 years ago, I think they were running at about a 70% cost of goods sold. So let's just say they get that down to 70% from where it is right now, because obviously lower sales, they have a lot of fixed costs. Now that gets you all the way up to $337, right? So some kind of combination of 50% plus sales growth and the fixed cost leverage that would explain is what IVoT would tell you is what the market's expecting. And where does that come from? Let's talk. Let's let Andrew kind of give his couple of cents on that.
Yeah, you have to remind me if I'm going on for too long. Otherwise, this is going to be a long form. So with Tesla, even though existing revenue is roughly about 70% from making cars, right? Actually, last quarter, we have a positive surprise, you know, a pleasant surprise when it comes to delivery. And mostly it's because folks are buying ahead of the federal tax credit expires, and that's why the promotions came on. Well, now, you know, there is the standard pricing for Model 3, Model Y, so that instead of coming up with the, listen, $25,000, $30,000 car with the whole new lineup and manufacturing, no, we're not doing that. But instead, Tesla is coming out with the standard Model Y and standard Model 3. So you can get one of those around $30,000 or so, you know, 35, $1,000 in that range, roughly around that range, and with the option of having full self-driving. Now that's truly astonishing because, the average price for a US car is about $50,000. That's the medium average price. Can't compete that, right? China making cheaper cars, but then the tariff is preventing them from coming in. But nevertheless, we do expect for cars, selling cars for the next quarter, it could be a little bit more anemic because the buyers are jumping ahead of the federal tax credit reduction on the end of it. But overall, I think Wall Street and investors, retail investors and institutional investors are starting to understand that Tesla is crossing over from being just a car manufacturer and into an AI and manufacturing powerhouse. Literally, there is no other company that is better positioned when it comes to manufacturing, energy, autonomous technology, and also robotics. When you combine all this together, it is a tech conglomerate and not just a car company. And therefore, what do we have to look forward to? Well, how do you justify this explosive sales growth? Well, we can dive a little bit. I'm not even going to get too deep. I'm just dive on the surface just to look at
Yeah,
the
this is the business
revenue
guy. Sure.
from selling cars, making cars and selling cars. At best, if you look at the most successful or the highest volume seller, well, it is Toyota, right? What kind of revenue are they really making? Well, I'll tell you, at best, they're making high single digits to very, very low double digits. That is the net profit from making the vehicles. Okay.
Right.
Yeah. And Tesla, it's about 15%. That's already very good. 15% because why? They are vertically integrated. They don't have to worry about too much about other suppliers, tier one, tier two, tier four, giving them trouble. And then their systems are basically in sync with one another. That's why the software updates makes the car appreciate versus depreciate. Okay.
Well, also they realize full selling price, right? So they don't have distributors. They
don't.
sell directly to consumers.
Yeah.
So the $30,000 is probably the equivalent of 50,000 at Toyota.
Yeah, and for other OEMs out there, every year the dealers get together with the maker, the manufacturer, and they talk about how is different markets and then what kind of order are they going to place, because then that's when they know how many cars to produce, right?
Right.
And the landscape is always changing, right? Just like
Yeah.
the luxury sedan is no longer needed anymore. Like the top end luxury sedans, nobody buys that anymore. Everybody's buying SUVs. And so the landscape is changing. And so what we have to look forward for Tesla is really full self-driving, autonomy, and robotaxis. They're rapidly expanding from this current footprint. I mean, compared to Waymo has been business. Again, I've been saying this for 16 years
Yeah.
already, but they still cost way too much. You're looking at a unit that costs, the cost basis, right? It's about $100,000 to $140,000 for Waymo. But if you look at a standard Model Y, their cost basis is about $30,000.
Yeah.
Robotaxis that's going to start to debut towards the end of next year, it's going to be even cheaper because it doesn't even require paint, right? And so that's going to be the focus. And in terms of autonomous technology or full self-driving advancing, we're hitting version 14. I'm not lucky enough. I have two Teslas. I didn't get the update yet, but when I do get it, it's going to be something amazing. Because now FSD can actually be in the parking garage and look for a parking space for you. It can actually back up. When you're coming out of a shopping mall and it's raining, you know what? I think I'm going to summon my car so that it'll come to within 10 feet of where I am. So I'm holding these shopping bags. I can just go there.
But
Also,
does that equate to new revenue? Because it's all about earning
yes,
revenue.
I'm about to get there because that's the reason why I brought up 15% of making cars. When it comes to ride hail, right? The revenue for software as a service is at least 50 to 60%. At least 50 to 60%. Okay. And we're talking about cost per mile. We're talking about under $1. Okay. Uber is still anywhere from, I believe, at least $2, if I'm correct. Last time I checked, it's still $2 a mile with the driver, right? So now you have level 4 autonomy, and then don't even talk about Waymo because their cost is way too high. And then the total addressable market for ride hail in the US, last time I checked, it's about a little shy of $30 billion. Okay. It's about 28 and a half in 2024. And so when you look at the total addressable market, and again, it's not winner take all, it's winner take most, and the pie is just going to grow. And full self-driving, it's going to be right now, Tesla is just being really careful. They could remove that driver already. Level 4 is already here. They just want the data to be even better. Why? Because they can, and it is getting better to basically release the safety drivers or the safety patrol in the driver. So it will expand.
I know we cut you off, but I think we're running out of time here. But I just want
we're absolutely running out. And then I didn't even get to Optimus, and that it's going to be the biggest revenue generator.
So you think that? So let me ask you a question. Going into the quarter, I guess this is all forward looking, right? So there's nothing in the quarter that we're going to see that's going to really impact this vision of yours that I hear.
Yeah, and Wall Street is catching up to this, is that they have to use future earnings as a huge component in their cash flow model or whatever model that they're adapting. And that's why across the board, we are seeing a lot of upgrades for the Tesla stock. I mean, it wasn't too long.
Well, yeah, someone came out today with a $520 price target. Now, I will tell you, though, as an investor, that's not a buy in my mind. And they're like, oh, it's a buy, 520. But again, the way I look at the markets, I'm not buying something this volatile if it's only a 40% return, not even 30% return. So,
there are price targets for investors, long-term investors, and then there are price targets for traders. And it seems like Wall Street is catering to the short-term traders. And that's why they only have 12 months target and they change it.
I'm long-term investors. So
exactly. So
all I'm saying is, right now, just to get to where it's trading, we need 70% cash flow growth compounded for 70% for the next 3 years. Obviously, when does that kick in, and when do we actually see real evidence? It's kind of like, no, I mean, again, it's great to have the idea of it.
Yeah.
You're highly convicted in it, and that's, I'm not convicted or unconvicted. I'm a neutral at this point because I just haven't done enough research to really say all these things you're saying. But I would like to. I mean, hopefully when we have more minions here at IVoT.
But Emile, wouldn't you be negative looking at your IVoT forecaster, saying that they have to hit all of these incredible benchmarks, and they have to hit them and exceed them to make it even suitable for $428 a share where it's selling at now?
Well, let's put it this way. I think I'm very you have to make some huge assumptions in terms of cash flow. I mean, 70% cash flow growth over 3 years is a huge amount. On the other hand, this is a high fixed cost business. So the leverage on sales growth here, we saw it when we did the tool, right? Sales growth had an impact from 70 to 120. Cutting the costs because they're leveraging their fixed cost structure took that up to 320. And they've had gross margins as high as 35% in the last 4 years. So I would say I would want to do some serious, at IVoT, let me just one more thing. What we're looking at with that tool is a level 1 tool. We have level 2 tools where you go deeper into the company to look at these issues that Andrew's talking about more specifically. How many robo cars do they need to sell? How many batteries do they need to sell? What is the fixed and variable cost? We can go all the way to level 3 with our tools to forecast cash flow much more specifically. And, we're talking before we started the show today about you guys are launching potentially new content, which is really exciting, and hopefully we can all leverage each other's content from each other. I absolutely want to launch a show with deeper dives into our companies where we go to level 2 and level 3 and where we really can, let's say, put Andrew's assumptions to the test from an IVoT perspective. Again, that's what I did 20 years on Wall Street as a fundamental investor. We dug deep for years on companies to really know what the market didn't know and have conviction. Either way, what I'm looking for is 100% conviction that this thing's worth $1,000. Okay, then we own it.
Yeah.
I'll pay $444 even if it's only worth 70 if I think it's worth 1,000. That gives me risk reward, right?
Yeah, but when you say that you're not positive nor negative, I would think that something that if it just does steady Eddie is going to be worth $70 a share and it's selling at 428, I would think that that would be a negative on the stock.
Well, let me put it to you this way. It's like buying Amazon at 2010, around that time. It was just not, it doesn't make sense. If you look back in the rearview mirror, the revenue doesn't give you that clue. They were sacrificing their revenue, for market share. They have something in mind and they were building it. I think that is one of the really good comparison. Buying Amazons in the early 2000s, 2010, at that time, when people thought that Amazon was going to go out of business. What is this? This store that sells books, and it be, and sure enough, it is, becoming what it is today, and it has to go through some painful journey, and investors along the way. But envisioning where the future revenue is going to come in and what's their net profit margin is going to look like. And again, from selling cars 15% to selling battery packs, the mega pack facilities 20 to 25%, right, to software as a service to 50 to 65%, and then Optimus would be around the same range in terms of percentage of net revenue. I think this company deserves all the multiples that it's giving right now, reflecting what the market is saying.
Okay, well, I'm going to go with you, Ed, for a minute here. Let's just say, first of all, what you're saying, the tool is meant to bring a reality to this conversation. To say, in order to, they just did $22 billion in the last quarter in sales in the quarter. That's a lot of money. That's a lot of sales. In order for them to grow with 50% over the next 3 years, they're going to be $75 billion per quarter in sales in 3 years. That's what we're talking about, from 22 to 75 billion in 3 years. Do I think that that's a stretch? Honestly, for me, it's going to take a lot to convince me that that's the truth. And by the way, Ed, to your point, that becomes a neutral. That's all to make it just worth $444, which is what I'm paying for it right now. And I'm not buying a stock because I think it's correctly priced. I want at least, honestly, in my way of looking at things, I want 100% return. The minimum I'm looking for is 40%, but in a stock with this volatility and this competition and these issues, I'm only going to be happy if I can model this and say it's not going to be 75 billion, it's going to be 150 billion in 3 years based on these things that Andrew's talking about. Now, is that possible? I just don't know. Like I said, we need to do a deeper dive, but I agree with you, Ed, that given the tool, it's just trying to tell you, hey, Andrew, can this thing get to 150 billion per quarter in 3 years? I don't even know if it's got the fixed cost structure to even support that, to tell you the truth.
There's so many other choices out there, and there's other choices on investment shows, and I think that the two of you bring the best out in our industry. I really appreciate you both being here today, and we're going to cut this off now. But thank you very much, guys.
I appreciate you having me. Thank you.
Thank you for watching IVoT Eye on Investing. Please subscribe to our YouTube channel and click on the link in the description to register for early access to the platform opening soon, which includes access to our powerful IVoT forecasters and fundamental investment training.